Welcome back to the deep dive. Our mission today is simple, but it's absolutely crucial.
It really is.
We're going to be peeling back the layers on the residential real estate market to understand something that feels, well, it feels like a contradiction.
A huge one.
The official public data says everything is stable. Maybe a little soft, maybe a plateau.
Right. The headlines say resilient.
Exactly. Resilient. Yet you, the average middle-class buyer, you feel like you are standing at the edge of a financial cliff.
It is the defining disconnect of the current housing economy. I mean, if you just look at the macro indicators,
The MLS data, that kind of thing.
the multiple listing service data, the median sales price reported nationally, you see a market that appears, like you said, resilient, if not slightly cooling.
But on the ground.
But on the ground, among the vast majority of people who are simply trying to buy a stable place to live, there's just this growing, almost suffocating sense of distress and anger.
Exactly. And that's what we're looking at today. We're calling it the phantom housing crash.
A phantom crash. I like that.
It's happening, but it's all happening in the shadows, totally hidden from the public eye. And this distress, it's being driven by these twin interlocking forces.
Okay.
So on one side, you have the catastrophic failure of the passive income dream. We're calling it the Airbnb Bust.
The amateur speculator imploding.
That's it. And then on the other side, you have this highly coordinated, large-scale acquisition of that exact same distressed housing stock by institutional investors.
The corporate landlords.
The corporate landlords.
And, the central conflict here is that the middle class is just getting squeezed out entirely. And it's not by some, gentle, organic economic cycle.
No, this feels different. It feels structural.
It is a fundamental structural shift. For the last few years, speculators just flooded the market. They treated housing purely as a tradable asset, a commodity to be exploited for quick cash flow.
And in doing so,
They ruined the market structure for genuine home buyers who simply wanted a place to live, a place to build some generational equity.
I think that framing is just. It's essential. This entire deep dive is built around that finding. The speculators, both the amateur and the corporate, they ruined it for everyone else.
Yeah.
And we have to hammer home the foundational problem right from the start with this analogy.
Okay.
Neighborhoods were never meant to be unregulated, decentralized hotels.
Right. They're communities.
They're communities.
Yeah.
And the disastrous consequences of treating residential housing like a commercial nightly rental business are now hitting the fan. And it's the potential homeowner, the one who played by the rules and saved their down payment, who ends up paying the steepest price for all that speculation.
That is the gravity of this specific moment. We are not just seeing a price correction. We are witnessing an unprecedented transfer of housing stock.
A transfer from who to who?
It's moving from what we might call the middle-class speculator, the amateur who got in too deep, relying on really shaky financing, straight into the hands of the corporate lord on Wall Street and in Silicon Valley. And this process, it's fundamentally changing the fabric of our society. It's turning stable communities into these volatile cash flow assets for remote hedge funds.
And our goal today is to give you the playbook. We want to pull back the curtain on this so-called dark market.
Yeah, to show people what's really going on.
We want you to understand exactly what those institutional investors are doing, how they're acquiring properties without anyone noticing, and how you, the genuine home buyer, can navigate this minefield and maybe position yourself to secure a home when this shadow inventory finally breaks the surface.
Okay.
Let's unpack this. Let's start with the domino that fell first, the amateur hour, the Airbnb hustlers who really set this whole crash into motion.
For the better part of the last 5 years, especially during that low interest rate environment,
The pandemic boom.
the work from home boom,
Bill.
the digital airwaves, your YouTube feed, financial guru newsletters, all of it was just absolutely saturated with one hyper-aggressive narrative.
Passive income.
The get-rich-quick promise of passive income.
And that dream was so seductive because it seemed accessible to everyone, right? The pitch was so simple.
It was. The Fed is keeping rates at zero, inflation is taking off, and hey, real estate always goes up.
So buy a second house or a third. Put it on a short-term rental platform and just watch the money roll in while you sip margaritas on a beach.
Become financially independent. And our source material details this just beautifully. It shows that this wasn't just wealthy investors. You had teachers, dentists, Uber drivers, people across the middle and upper middle income spectrum who got severely levered up.
They used every credit line, every penny of savings, and critically, these high-risk debt products to buy second, third, sometimes fourth homes.
And the key element here, the absolute key, is the purpose shift.
What do you mean by that?
They weren't buying these homes because there was some lack of available housing for residents. They were purchasing them specifically to run what were, in essence, highly profitable, unregulated hotels inside residential neighborhoods.
And that right there is where they started the contamination process.
Absolutely.
They leveraged this short-term rental tech to just bypass local zoning, community standards, basic obligations that a traditional landlord or homeowner has to abide by.
They completely stopped seeing those homes as part of a street or a school district or a community.
It just became individual commercial zones.
Focused solely on the highest possible nightly yield. And that is precisely where the damage to the middle-class market began.
So what's the verdict now in 2026?
The party is definitively over. The Airbnb bust is real, and it is happening right now. We're seeing this lethal cocktail of sinking bookings. Demand is normalizing, or in some places just drying up, combined with massive, unsustainable supply growth.
How much growth are we talking about?
Sources indicate a staggering 100% supply increase in some of these speculative cities.
Double the supply.
A doubling of the supply over a very, very short period, as hosts saw their neighbors getting rich and just piled in during 2022 and 2023.
And when you double the supply overnight while the general rate of tourism and travel stays static, the economics are just brutal.
Oh, they're brutal. Those once shiny passive income properties have very quickly turned into active liabilities. They're just eating cash every single month. They sit vacant or have to operate at these heavily discounted rates. Hashtag B, hypersaturation and negative cash flow. And this leads us directly into the cold, hard math of oversupply. This phenomenon we're calling hypersaturation.
So when we dive into the specific data for markets like Austin, Texas, or Phoenix, Arizona,
Nashville, Tennessee.
yeah, Nashville, all the poster children for that speculative Zoom town boom during the pandemic, the level of short-term rental saturation is genuinely astonishing.
It's hard to even wrap your head around. The source material confirms that in these cities, there are now more Airbnbs and other short-term units available than there are dedicated traditional hotel rooms.
Wow, just think about that from a municipal planning perspective.
Right. Entire major metropolitan areas have effectively doubled their short-term accommodation capacity. They've created two parallel hotel industries.
One of them is regulated, taxed, zoned commercially.
And the other is entirely decentralized, residential, and often just skirting all the local regulations.
And this saturation, this is the price crash mechanism.
It's pure supply and demand.
When the pool of available properties doubles, but the travel demand stays flat or maybe even softens because of economic uncertainty, the market just becomes flooded with options.
And all those hosts who are so comfortably budgeting their mortgages based on nightly rates of, say, $300.
The good times.
The good times. They are now in a frantic race to the bottom. They are forced to fight desperately for any booking they can get, dropping their prices to $150, $100, sometimes even less.
Anything to get some occupancy and cover at least some portion of their debt.
But here's the critical, painful financial factor. Their original mortgage payment, their insurance, property taxes, the cleaning fees, the management software subscriptions. All of that is still based on the optimistic $300 a night math.
So there's this massive gap.
The massive gap between the actual revenue coming in and the fixed expenses going out. It creates severe, persistent negative cash flow. Every single month, that house becomes a massive cash-eating liability.
And this leads us to the financial trap, which is really the ticking time bomb underlying this entire crash.
Yeah.
We're not talking about standard homeowners here. A lot of these amateur investors, they didn't use stable 30-year fixed mortgages based on their personal W-2 income.
The kind of loan we all recognize.
The standard owner-occupier loan.
No.
Instead, they relied heavily on these high-risk, non-qualified mortgage products that were really tailored for real estate investment firms, not for, a dentist from Ohio.
Specifically, we have to talk about DSCR loans.
DSCR.
Debt service coverage ratio. This is the financial instrument of the amateur speculator.
Okay, let's dedicate some time to explaining this clearly, because this right here is where the leverage snaps.
It is. So a standard bank assesses your income when they give you a loan for a house.
They look at my pay stubs, my tax returns.
Exactly. A DSCR loan, however, underwrites the mortgage solely based on the projected income of the rental property itself.
So not the buyer, but the house.
The house. The lender says, okay, this property must generate enough cash flow to cover the debt service plus a buffer. Typically, they look for a ratio of 1.2 or higher.
Okay, can you break that down with an example?
Sure. Let's say the house requires $3,000 a month to service all its debt. That's principal, interest, tax, insurance, everything. The lender requires the projected rental income to be at least $3,600.
That's the 1.2 ratio.
That's the 1.2 ratio. And if the host can prove, using really aggressive assumptions about nightly rates and occupancy,
The $300 a night math.
that they can meet that threshold, they get the loan, even if they personally have zero income. But what happens when the actual revenue suddenly drops by 50 or 60% because of saturation and price cuts?
Which is the Airbnb Bust scenario.
That's the Airbnb Bust. The DSCR ratio plummets below 1.0.
So the loan is now technically in breach of its covenant.
Exactly. The property is no longer covering its own debt service, and that investor is now deep underwater, forced to make up a multi-thousand-dollar shortfall every single month just to keep the bank from calling the note or, starting foreclosure proceedings.
So you now have potentially thousands of these individual investors all across the country, particularly in these speculative Zoom towns.
Who are technically in default or are just operating deep underwater, financially hemorrhaging cash.
This explains why the source calls it a ticking time bomb of forced selling. It's all this hidden leverage just ready to snap.
And the distress is currently invisible because the public housing data, the MLS, it's simply not engineered to capture these investor-centric default indicators.
Right. And that realization that the failure is happening but is currently masked, that naturally leads us to the next crucial question.
And this is probably the most perplexing and frustrating part of the current market for the average home buyer. If all this financial distress is real, if thousands of speculators are failing their DSCR loans, why aren't we seeing for sale signs on every lawn? Why aren't prices crashing publicly in the MLS data?
This is where the whole concept of the shadow inventory comes in.
It's the key.
And this directly addresses that immediate skepticism from our listener. The truth is, the volume of distressed assets is massive, but that volume is being actively and intentionally hidden from public view to prevent a visible market panic. So when a host realizes their Airbnb model is fundamentally broken, what's their first moves? It's not to sell at a loss.
No, it's deep denial.
Deep denial, followed by this desperate attempt to just hold on and stabilize the cash flow. They pivot their strategy entirely.
Right. They take their nightly rental off the platform and try to list it as a midterm rental.
What does that mean, midterm?
A 3 to 6 month lease targeting, traveling nurses, corporate interns, students, or worst case, they just drop it into the traditional long-term 12-month rental market.
And that strategy, that pivot, it has two profound consequences, both of which ripple out and hurt the middle-class renter and other investors.
First, it floods the traditional long-term rental market with units that were never intended for it. Suddenly, major cities experience this massive artificial influx of supply.
And these are often fully furnished, professionally managed properties.
Right. So what happens when that long-term rental market is suddenly flooded?
It depresses rental prices for everyone.
Exactly. Which, it's good for the tenant in the immediate term, but it further accelerates the failure of the original speculator. Their long-term rent income might only cover, say, 80% of their DSCR loan requirement,
pushing them even closer to the financial edge.
The speculator, in trying to save themselves, only drives down their own projected future revenue. It's a vicious cycle.
So eventually they reach the point of capitulation. They have to sell.
They have to. And when they sell, they avoid the public market at all costs. This is the crucial stage, the dark market transaction. Amateur hosts desperately want to avoid the embarrassment and, frankly, the financial self-injury of a public listing that just broadcasts a heavy loss.
Let's really consider the psychology here. I mean, if you're an investor and you bought a house in 2022 for $750,000.
The absolute peak.
And the current honest appraisal is maybe $600,000. If you list it publicly for $600,000, that does two things. One, it just broadcasts your failure to the entire world.
And two, critically, it establishes a new lower comp for every single house on that street.
Potentially dragging down the value of your desperate neighbors who are also trying to hold on.
So they sell off-market. They
Yeah.
never use the MLS, the multiple listing service, which is the data source for all public housing statistics. Instead, they use these closed investment channels.
How does that look like?
They contact wholesalers, they join private Facebook investor groups, or they call specific institutional cash buyers they know are looking for bulk deals.
And this is how that transfer happens in the shadows.
That's it. The house moves from a failed individual who ruined their investment to a massive corporation without ever registering on the public housing data.
So the data you see, the stable median prices, It's only reflecting the transactions that can still command a high price, or those that haven't entered distress yet.
The true volume of distressed inventory is completely invisible. It's a phantom crash because the assets are being sold in a dark marketplace. Hashtag TB, the negative equity contagion.
Okay, so now we have to talk about the collateral damage to the honest home buyer.
This is the part that makes people so angry.
Negative equity and the contagion effect. This is the mechanism that really proves the narrative. The speculators ruined it for everyone.
Many of these amateur investors, and frankly a lot of corporate ones too, they bought at the absolute peak in 2022 and 2023.
Fueled by FOMO.
Total FOMO, high leverage, and they were often paying 50% over the asking price, waiving all contingencies just to secure the asset in a hyper-competitive environment that they themselves had created.
The math on that today is just brutal.
It is. If an investor scraped together 20% down on that property, and that property's value softens by just 20%.
Which is entirely plausible in these overheated, now saturated markets.
Their entire down payment is gone. Their equity is completely wiped out. They are officially underwater.
Meaning the debt they owe the bank is now more than the property is worth.
And they have zero financial incentive to continue pouring cash into a sinking liability.
And this is where that investor psychology is so radically different from stable homeowner psychology.
It's night and day. If you, an owner-occupier, go underwater, you typically try to hold on. You keep paying the mortgage because you live there. You value the stability. You use the house. You desperately want to avoid the life-altering consequence of foreclosure.
But an investor
Sees this purely as a business calculation. If the asset is underwater, requires a significant cash infusion every month because of negative cash flow, and has no prospect of appreciation in the short term, the financially rational decision is to strategically default.
or sell quickly at a deep, deep discount just to stem the flow of losses.
And this forced, desperate selling is what creates the negative equity contagion. This is the specific financial injury inflicted upon the honest, long-term resident by the speculator.
Let's use a hypothetical example to make this really concrete for the listener.
That's a good idea.
Imagine you live in a stable neighborhood in, say, Boise. You bought your home 5 years ago. You have solid equity. Your neighbor, however, was an amateur Airbnb host who bought 2 doors down in 2022 for $650,000 using one of these DSCR loans.
Okay.
They just failed, and they sold off-market to a wholesaler for $500,000 cash. That transaction never hits the public listing, but it is recorded with the county.
Right. It's a legal sale.
Now, you decide you want to refinance your own stable home, or maybe sell it. The bank sends an appraiser to determine the current value.
And that appraiser is required to use all recent comparable sales, or comps.
Whether they were public or private cash transactions.
It doesn't matter. A sale is a sale. So when the appraiser finds your neighbor's $500,000 distress sale, they are compelled to factor that heavy discount into the appraisal of your house.
So a wave of forced selling from the Airbnb Bust means that the discounted prices from those desperate, hidden sales drag down the appraised value for the entire neighborhood.
Your house is now worth less, not because of your prudent financial decisions, but specifically because your neighbor, the failed hotelier who gambled with high-risk debt and lost spectacularly, dragged your property value down with them when they dumped their asset in the dark market.
It's the ultimate confirmation of the theme. The speculators inflated the price on the way up, making it unaffordable for first-time buyers.
And now they're contaminating the market on the way down, eroding the wealth of established, stable homeowners through this contagion effect. It's a total disaster.
So that failure, the amateur speculators' meltdown, it has created a massive, once-in-a-generation opportunity.
A feeding frenzy.
And there is a very powerful, highly organized entity waiting patiently on the other side of this trade.
The corporate landlord.
This is the second half of the crisis,
Yeah.
and, arguably the more permanent problem for the future of homeownership.
I think it is. When the amateur speculator sells their distressed asset, they're typically selling it to one of these institutional giants. We are talking about names like Blackstone, which owns Invitation Homes,
Precium.
American Homes for Rent. These aren't just wealthy individuals. They are vast, multinational, publicly traded real estate investment trusts, REITs, backed by literally trillions of dollars in institutional and pension capital. Hashtag, industrializing the American dream.
And they're operating on 2 tracks here. I mean, they are certainly happy to scoop up existing distressed housing stock at a discount.
Oh, absolutely.
But their most aggressive strategy right now is the build-to-rent scheme, BTR.
The BTR strategy is maybe the most visible and kind of dystopian element of this entire trend.
It really is. Instead of competing with the middle-class home buyer for existing older houses, these institutions go directly to developers, or they become the developer themselves.
And they build entire new neighborhoods from scratch that are structurally designed and intended to never be sold to individual families. They are built for perpetual corporate rental.
Imagine driving through a brand new subdivision in a rapidly growing city. It looks like the idyllic American dream.
Perfect lawns, picket fences.
Perfectly manicured lawns, uniform picket fences, two-car garages, maybe a little community pool. You stop because you're interested in buying a home there, but there's a key piece missing.
There's no sales office.
You search for the sales office and you find none. There is only a corporate leasing office. Every single home is owned by a singular entity, a hedge fund or a REIT based in New York or London.
This is the industrialization of the American landlord business. They are transforming what was previously a localized, relationship-based human transaction
A resident earning their home.
into a cold, hyper-efficient corporate structure. They're removing the human element entirely.
And they use that efficiency as a core weapon against the individual tenant. Our sources detail their methods. They use artificial intelligence and highly sophisticated algorithms to set and maximize rents.
The AI just calculates exactly what the local market can bear. It analyzes job growth, average income, even local amenity demand, all to ensure maximum yield.
Furthermore, they achieve these extreme economies of scale. Because they own every single house on the street, they can negotiate huge bulk discounts for maintenance, repairs, landscaping, management software.
The cost of owning and managing a single house is significantly lower for them than it is for a traditional individual landlord. Their goal is pure profit maximization and efficiency.
Not community development.
Not community development or housing stability.
And this perfectly defines the term subscription housing. They have taken the American dream, that tangible asset, the source of generational wealth that historically anchors a family to a community.
And they flipped it into a perpetually recurring, annually repriced expense. You pay a fee for shelter, a non-negotiable necessity that just locks the resident into perpetual tenancy and perpetual profit for the corporation.
And that transformation is so profound, it shifts the entire dynamic.
It does. When you rent from a human being, there's always the potential for negotiation or compassion or flexibility.
Right.
When you rent from an AI-driven system, there is only a calculation. The lease renewal email generated by an algorithm simply states the new maximized rent. If you can't pay it, the automated eviction process just begins. Hashtag B. The yield delusion and neo-feudalism.
Okay, let's address the skeptical challenge here. If they're building entirely new neighborhoods, aren't they technically increasing the overall housing supply?
It's a fair question.
I mean, doesn't that help housing prices stabilize even if the units are only for rent? Is it really neo-feudal if they're adding new stock?
That is an absolutely necessary question to ask. And yes, they are adding new physical units. That helps the total shelter supply number. But they are adding unbuyable supply. They are structurally eliminating the housing stock that transfers equity and wealth to the consumer. For the middle-class homebuyer, a BTR subdivision that adds 300 rental units is functionally identical to 300 houses being demolished.
They have zero impact on the supply available for purchase.
Exactly. So that makes their motivation critical. Why do these multi-billion-dollar corporations who could invest in anything from tech startups to oil, why do they want the headache of owning thousands of dispersed single-family homes?
And the answer lies in what we're calling the yield delusion, or rather, the strategic hunt for an inflation hedge.
It's a very sophisticated bet on macroeconomic instability. After the recent period of elevated inflation, institutional money realized they needed assets that could effectively reprice annually to maintain their real value.
Because traditional fixed income assets, like bonds, they get crushed in an inflationary environment.
They're disastrous. If a bond pays a fixed 4% coupon and inflation is running at 10%, that asset is hemorrhaging real purchasing power every single year.
But single-family rental housing, when it's held by a corporate entity, acts like the ultimate, nearly perfect, inflation-protected bond.
Precisely. Unlike a bond, a rental lease resets every single year. If inflation goes up 10% this year, the corporate landlord is strategically positioned to raise the rent by 10% or more based on market demand when the lease resets the following year.
So they don't lose purchasing power.
They pass the cost, and then some, directly onto the consumer. This makes single-family rental housing an incredibly attractive, stable, and essentially inflation-proof asset class for vast pools of capital looking for long-term, predictable yield.
And the ultimate really chilling bet they're making is on the necessity of shelter.
Yeah.
Unlike luxury goods or a speculative stock or commercial office space, which can go vacant, you cannot fundamentally default on your need for shelter. You have to live somewhere.
They are operating on the fundamental strategic assumption that the middle class is failing and will continue to fail to achieve homeownership.
They're betting on it.
They are betting that homeownership will become a genuine luxury good, one that will soon only be available to the top 10% of the population who can afford the inflated cash prices, the down payments, the high interest rates.
And everyone else.
Everyone else, the remaining 90%, will be forced into perpetual tenancy in this neo-feudal system.
It's a grim analysis, but it provides the perfect strategic explanation for their current behavior.
It does. They are simply waiting for the market to fail the middle class, aided by the collapse of the amateur speculator, and then they swoop in to capture the assets, industrialize them, and turn them into long-term cash machines.
So the amateur speculator's failure is simply the corporate landlord's biggest buying opportunity.
That's the trade.
So, okay, we've established the catastrophe.
Mm-hmm.
The amateur speculator failed. They're dumping assets into a dark inventory, and the corporate landlord is ready to buy that inventory and industrialize the housing supply.
A bleak picture.
So what does this all mean for you, the listener, who is just trying to buy a stable house right now? This crisis is a financial minefield, but understanding the playbook allows you to navigate it safely.
The first critical point is realizing that this crash is not uniform across the nation.
Right.
If you live in a stable, older Northeast market or a historically slow-growth Midwest town, you might not see the distress reflected in your immediate neighborhood. This crash is intensely geographically concentrated. Hashtag tag, tag, tag A, spotting the hotspots and distress signals.
So we need to identify the hotspots. These are the Zoom towns where prices doubled or more between 2020 and 2023.
The places that got all the hype.
All the hype. It was due to the work-from-home influx and critically intense high-leverage speculation. We're talking about places like Austin, Boise, Phoenix, Nashville.
And vast swaths of Florida, particularly the coastal areas.
These overheated markets are the most vulnerable, precisely because they have the highest concentration of those failed DSCR loans and amateur short-term rental investors who bought right at the peak valuation, often paying ridiculous premiums.
This is where the shadow inventory is the deepest and where the contagion effect will be the most severe.
So if you are looking to buy in one of those areas, you need to know how to spot the distress signals because, as we've discussed, the visible for sale signs on the MLS are intentionally misleading.
You have to look for the secondary market indicators.
Okay, like what?
First, you must monitor the days on market. If this number is steadily creeping up from, say, 10 days to 30, then 60, then 90 days, that is a clear sign that buyers are becoming selective.
Or that sellers are attempting to command prices that the market simply cannot bear anymore.
Right. Then you look for successive price cuts. Any seller can drop their price once if they were a little overly ambitious.
Sure.
But 2 or 3 cuts in quick succession, $15,000 off, then another $10,000 off, then another $5,000 reduction. That signals profound distress on the seller's part.
They're aggressively chasing the market down. They're desperate to exit fast before their cash reserves completely run out.
But the definitive sign, the true smell of blood in the water that our source material highlights, is a listing that includes the phrase, furniture included.
That is the unmistakable final mark of the failed Airbnb host.
It's the tell.
They aren't just selling the house as a property, they are desperately liquidating the entire failed business operation. They want the entire investment package gone, down to the last decorative pillow, the smart lock, the set of commercial linens.
Because they are bleeding cash and they cannot afford the cost or the hassle of moving or storing all that commercial furniture, it signals total capitulation.
And this is exactly where the smart money, the truly patient institutional capital, is positioning itself.
Right now, they're avoiding these overheated markets, or at least they're waiting on the sidelines. They know the current prices are still too high. They reflect the seller's hope, not the asset's true value.
So they're waiting.
They are waiting for capitulation, waiting for these amateur investors to exhaust their last savings and be forced into massive discounts, or, eventually, the public foreclosure auctions. Hashtag B, the smart money playbook for homebuyers.
Okay, so we've distilled the strategic advice from this entire deep dive into 4 critical, actionable guidelines for you, the middle-class home buyer,
Yeah.
to successfully navigate this unique market and avoid being caught in the speculative crossfire?
Guideline number 1 is crucial. Don't catch the Airbnb knife.
What does that mean?
The full weight of the supply from failed hosts, that massive shadow inventory, it has not yet fully materialized in the public market. You need to wait for that supply to hit, specifically through foreclosures or bankruptcy sales.
Where the banks force the sale.
And the true price discovery happens at the lowest possible point. Buying now means you might be catching the house from a slightly desperate seller. Waiting means you might catch it at the true bottom when the institutions start buying aggressively.
Okay, guideline 2. Avoid the build-to-rent trap.
This is a big one. If you're considering buying a house, especially a new build, you must research the ownership structure of the surrounding area.
And how do you do that?
You can look for generic community names, look at the public property records to see who owns the majority of the houses on a new street, or see if one single property management company is listed for dozens and dozens of homes.
And if that subdivision is dominated by corporate rentals.
Do not buy there. Your property value will inevitably be capped by their rental business model, their AI-driven calculation of maximum rent yield, not by organic home appreciation driven by owner-occupiers who reinvest in their property.
You're essentially buying into a commercial zone that just looks residential, and your personal equity growth will be stifled by their corporate yield strategy.
Exactly.
Okay, third piece of advice, and this one feels fundamental. It's about prioritizing use over speculation. Look for the user market.
Prioritize buying in boring, established neighborhoods, places where people actually live, raise families, and maintain their homes for long-term residency.
Not for flipping or vacation rental cash flow.
Stability should be your priority over hype. If a market doubles in price in 3 years, it's a bubble fueled by speculation. If it grows steadily and predictably at 3 to 5% a year, it's a stable home for wealth creation, and it's insulated from all the chaos we've discussed.
And finally,
Watch institutional flows. The corporate players are not sentimental, they are strategic. You need to monitor when the major players like Blackstone or Invitation Homes begin actively selling their assets on a large scale.
if they start liquidating their portfolio, what does that signal?
It signals they see a market top or significant weakness ahead. Conversely, if they start aggressively announcing massive new buying initiatives, it may signal they believe the bottom is definitively in. Their transactions, often disclosed through their REIT filings, are the ultimate leading indicator of where the true patient money is moving. #C, the final squeeze.
So the central finding we have to reiterate as we conclude is that the market is irrevocably splitting.
It's bifurcating.
The stable owner market, the long-term residential housing stock, is pretty much frozen, just waiting for a shift in interest rates. But the speculator market, the highly leveraged high-risk assets, that market is actively crashing in the shadows.
And in that crash, the American dream, which has been the key mechanism for wealth generation for the middle class for generations, is actively being privatized, captured, and transformed into a predictable, inflation-protected cash flow asset for institutional investors who have zero interest in community or stability.
It's the ultimate two-pronged squeeze on the middle class. First, they were tempted and bankrupted by the lie of easy money from the amateur speculators.
Then their subsequent failure was exploited by massive corporations.
And now the middle class is left with fewer homes available to buy, higher costs of entry, and the distinct possibility of becoming tenants in perpetuity. #tag outro.
So this deep dive has really exposed the anatomy of the phantom crash. You have the amateur failure of the Airbnb hustlers, the critical role of dark inventory in masking the market distress from public view, and the calculated strategic rise of subscription housing under the corporate landlord model.
We really want to stress the importance of knowing this information. Understanding the exact mechanisms of this housing minefield, knowing what a DSCR failure looks like, what BTR means for your future equity, that is your best defense.
This knowledge is what separates you from becoming a victim whose ability to achieve homeownership is dictated by algorithmic rent-setting models and high-frequency Wall Street speculation.
So we'll leave you with this final provocative thought, which ties together the collapse of the individual speculator and the rise of the corporate lord.
Okay.
If institutional money views shelter purely and ruthlessly as an inflation-protected bond asset, and they are actively using their capital to build entire neighborhoods that are structurally designed never to be bought, only rented forever, is homeownership effectively becoming a relic of the past for Gen Z and future generations?
Are we witnessing a permanent structural change where younger people are destined to be lifelong tenants in the neo-feudal system, created first by naive speculators and then cemented by massive corporations? You really have to consider the profound societal implications of shelter being irrevocably treated as a high-yield asset versus a fundamental human need essential for building a stable society. Think about that as you watch the market unfold over the coming years.